In this video, we'll discuss a market where the bulls remain in control. For investors, the longer-term risk-reward remains unfavorable. This is a trader's market. We'll cover risk-reward in this video in detail. We'll begin by looking at markets with similar technical profiles historically and review what their risk and reward outlook looked like in the past so we can learn something about the present. We'll shift gears to DeMark, S&P 500 index. We'll look at a daily, weekly, monthly, focusing on the counts and risk reward. Also look at DeMark charts, daily charts for two leaders, small caps, the IWM, ETF, and transports, IYT is the ticker symbol. We'll close with standard charts, looking at the recent candlesticks that we've had, a consolidation pattern, talk about which way it may break. Consolidations tend to break up or down, and we'll compare momentum now versus the last time we had a similar candle consolidation. Nothing new on this slide. Bulls in control. Bears need a catalyst. Walmart, Friday, potential catalyst. Elections looming in Italy, potential catalyst. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. The question for most of us in the markets today should not be, do we believe or think the markets can go up? We should always be thinking about what is the probability that the market goes up, what is the probability that the market goes down, which speaks to risk reward. We have what we call a similar markets model or a similarity model, where we can take the market's current technical profile and quickly use the model. It'll scan through our database and it will pull historical periods that look similar from a technical perspective. So here are the dates. Now let's just show what type of data is behind these dates to show you how detailed it is. How do we identify that September 1st, 1986 is similar to the closing level last Thursday in 2013? The similar markets model uses the CCM Bull Market Sustainability Index and the CCM 80/20 Correction Index as input or a basis to compare the past to the present. And the purpose of showing you this, and you can find this chart on our website under the Bull Bear Index tab on the home page here in the left-hand margin. If you scroll down, you can find this table. So we're comparing market profiles on a daily basis using these parameters, weekly and monthly. So what it tells you is, do I have a market that looks similar when I look at a daily chart, a weekly chart, and a monthly chart? This is the BMSI. Let's look at a similar table or flow chart for the 80/20 Correction Index. Again, we're on the CCM website. If you want to find this from the home page, there's the Bull Bear Index that we just looked at. There's the table we just looked at. And the Correction Index here. In terms of why these models were built, I think this quote encapsulates it. In the markets, you can't expect to win unless you know why you lose. It's all about risk reward. How would I have known to consider stocks in March of 2009? How would I have known that the risk reward ratio was deteriorating in October of 2007? This gives you an idea when we run this similarity model. Daily data, weekly data, monthly data. So when we look at the spreadsheet next, you know that the dates over here in the left-hand margin had similar profiles using these on 3 different time frames, which is very, very relevant. Before we go to the risk-reward table for the similarity model, let's look at risk-reward ratios for typical markets. Come down here. This is a risk-reward table for the Bull Market Sustainability Index. This is basically what a bear market looks like. Very unfavorable risk-reward ratios below 1, This area here is somewhat of a neutral market. When you cross this threshold here, this is the sweet spot of the risk-reward curve. And notice some of these levels here, a 12, a 13, a 36, a 16, a 22. These are very favorable technical conditions. These are very unfavorable technical conditions. This is what an overbought market looks like. Now, on this model, we're at 99, which means we're in this portion of the table here. So before we go look at our similarity study relative to the present market, it's good to know this is looking out here 1 month and 2 months. So typically, looking out 1 month in a bull market, your average risk-reward ratio is 3.67. Looking out 2 months, it's 3.3. Your median is 1.6 looking out 1 month, and your average is 2.38. So let's look at what the risk-reward ratios look like relative to those similar markets. Again, just to describe what we're looking at, what we did here is you go out and you say if September 1st, 1986 is similar to the close on last Thursday of 2013, what we did is you go and you look and you see how did the S&P 500 perform starting on September 1st, 1 week later, 2 weeks later, all the way out to 8 weeks. Then I can calculate a risk-reward ratio. Net bottom line, the risk-reward ratios down here are not favorable. This looks like bear market territory. If my typical risk-reward ratio is a 3, we're below 1 now. This is unfavorable. It tells you the odds are stacked against you. And how do we calculate that? Here are the instances. There were 20 cases with markets that look similar going back all the way to 1981. The fact that there are only 20 cases tells us that the technical profile that we currently have in February of 2013 is rare. These are the returns. They're sorted from highest to lowest. What we can find out is looking out 1 week, in 10 of the cases, the S&P 500 gained looking out 1 week. In 10 of the cases, it lost. Percent wins, 50%. Percent losses, 50%. My average gain, which is the average of these numbers, was 1.35%. And my average loss was negative 0.41%. You can figure out a risk-reward ratio from that, as you might imagine, with 50-50. And these numbers being similar, my risk-reward ratio is close to 1, but below 1. Looking out 2 weeks, it's even worse. That's a horrible ratio, horrible risk-reward. So what that tells you is if I took new cash today and invested it in the S&P 500, my upside potential versus my downside risk looking out on these parameters is unfavorable. What this table also tells you is, could stocks go up? Absolutely they could. Here are all the instances where investors that invested in similar markets made money. It's all about risk and reward. These are not good ratios in terms of putting new capital at risk. It doesn't mean we can't invest here. It means that A, we wouldn't be comfortable putting much capital at risk. Maybe 10 to 30% of our capital is appropriate if we find something. B, you have to give your positions a very, very short rope in this environment because you know that the odds are stacked against you. Now we're looking at a daily DeMark chart for the S&P 500. You can see the daily up here in the left-hand corner. DeMark charts and indicators are proprietary tools from Market Studies LLC. If you're new to the fold, a 9 paired with a 13 in DeMark speak tells you we have a higher probability of trend exhaustion. This is an uptrend here on the daily chart. The 9 paired with this 13 tells you have a higher probability of a reversal here. This is December 19th, 2012. We did get a reversal. Good signal. Down here, at the end of 2012, we hit a bottom and we came back up. So let's talk about risk reward. One reason why we like DeMark, his approach and his market studies are radically different from our approach and our market studies. I like that. It's not an overlap, it's almost a check. So our models, our tables, our research tells us that we've got a poor risk-reward ratio here. What does DeMark say? Here's a 9 paired with a 13 that you might not be able to see here. This 9 and this 13 is similar to this 9 and this 13. What does it tell us? It tells us that as long as the S&P 500 stays below 1533.45 or 1533 in round figures, this 9 and this 13 tells us we've got a higher probability of trend exhaustion and a reversal. Note, I'm always using the term probability. Can markets move higher when you get 9 and 13s? Absolutely, positively, yes. But until we clear, or better yet, close above 1533.45, we're going to respect this signal. This is 13.6 points away from this close to this point here. These are propulsion magnets. The downside magnet here, meaning if you understand the way markets work, this market, if it's in a normal pattern, wants to come down in this direction. It's at 1459.11. That's 61 points of downside risk here versus, to figure out whether or not this 9 and 13 might be valid, 13.6 of upside. We'll respect this and continue to be careful, maintain a high cash position, but we'll also keep an open mind. Now let's shift gears to a weekly DeMark chart. It's more meaningful when these signals align on multiple time frames. This is the weekly S&P 500 DeMark. We have a 9 here paired with a 13 in the present day. 9, 13, higher probability of a reversal. The magnet in this case is down at 1377 or 1376 and change for the S&P 500. What does the monthly chart look like? Here's the monthly. We do have one count. DeMark has 4 different counts. There's a combo, aggressive combo, sequential, and aggressive sequential. We've got a 9 paired with a 13. It's still active. How do I know that? This line is still here, and it's a dotted line instead of being bold. The level there is 1552.46, and what that tells us is this 9 and 13 probabilistic exhaustion and reversal signal has a higher probability of being meaningful as long as this market stays below 1552.46 or 1553-ish. If we move above that level, the probability of this being a good signal starts to diminish. Now, for fair and balanced, on the daily and the weekly, we looked at the standard combo count. This is the aggressive combo. So if we want to keep an open mind, the combo count is on a 911, which says to get to a 13 here, the S&P 500 would advance roughly for a minimum of another 2 months after the month of February. The downside magnet here, and these adjust over time. This can change as markets change. Where it sits now is at very, very low levels. It's at 1070. The shorter the time frame on the chart, anecdotally, I think the higher the probability that the magnets come into play. When you come on a monthly chart, sometimes the magnets can get pretty far away, but this is still meaningful. This still tells you that from a probabilistic perspective, this market may want to reverse. This is a daily DeMark chart of the transports, or the IYT up here in the left-hand corner, ETF. What we do in this environment, and I think a good rule of thumb is, if you're concerned about a market reversing, always look at the other side of that argument, which in this case would be if you believe that the risk reward favors a reversal, try to find markets, ETFs, stocks, indices, asset classes that meet your bullish criteria. If you can find a lot of good risk reward buy candidates, that tells you something about the health of the market. If you have difficulty finding good risk reward buy candidates, that also tells you something. So last week we go out and we look for strength. What this tells us here on IYT, it still meets my criteria as a market leader. It makes my short list, and then I come to the daily DeMark chart, and what do I find? Am I comfortable buying this last Friday? We've got a 9 on the daily chart here where my cursor is, paired with this 13. That's a potential exhaustion signal that I know is still in force because this line here is at 108.01. So just like the S&P 500, it says that this 9 paired with this 13 from a probabilistic perspective is still in force until IYT can clear and more likely or more comfortably hold above 108.01. It closed Friday at 105.77 for the IYT ETF. Now, in addition to the 9 and the 13, we have another 9. This is a buy setup, arrow up, market responded. Sell setup, arrow down, market responded. Now we have what's known as a 9, 13, and a 9. This is an even higher probability of a reversal here for IYT. The purpose of showing it to you is when we're looking for buy candidates, with my knowledge of DeMark and the markets in general and where we are, I can't buy IYT with a clear conscience looking at this chart and looking at the big picture. That doesn't mean I'm going to be right. IYT could blow through this and move higher for several weeks or several months. Simply looking at risk reward and understanding the odds and probabilities that are in front of us and maneuvering. When you've got a good hand in blackjack, you have a tendency to bet more. When you've got an unfavorable hand, you may not bet anything. You may fold. You may leave the game. The markets are similar. We have to understand risk and reward. The risks are higher here. It doesn't mean there's not potential reward. If you've recently picked us up on Twitter or on the internet, I also want to make it clear that if you've been following us for a few days or a few weeks, you may label us as perma-concerned or over-concerned. We bought here. Right here is where we started buying aggressively. This is an excellent risk-reward entry point. Here, not a very good risk-reward entry point. Small caps, IWM, daily DeMark chart. This, fair and balanced, a 9 paired with a 13. Market advanced. So when you have a strongly trending market, you can move higher after a 9 and 13. I can't overemphasize that. The fact that the line here is bolded tells you that this is a qualified breakout from this 913, and that qualification turned out to be a good signal. Basically invalidates the 9 and 13, and this market continued to go higher. From a risk-reward perspective, happy to take some of these gains that we were able to capture in here, not really looking to squeeze the last few pennies and nickels out of here with the downside risk. The downside propulsion target is at 86.61, which is much, much lower than the region that we sold it in late January of 2013. IWM, daily chart, looks good now. Friday, if I go to say, am I comfortable buying IWM, I've got a 9 here paired with this 13 staring me in the face. I've also got a risk level at 91.80. Friday, we closed below it at 91.74. Now, if you want to give fair and balanced coverage here, we did, this is 91.80. The high on Friday was 92.03. You can see intraday, we exceeded that. Experience tells me that it's possible that this market may push higher, but I'm not going to guess. We're still below 91.80. We have a 9 and we have a 13. Higher probability of a reversal. These levels up here are probably within the realm of reason, 93.54 and 93.66-ish in this area. If this is a good signal, we would reverse relatively soon and start moving back towards 86.61. Moral of the story, market leader, I'm just not comfortable buying it as it sits now. I would have said the same thing here. Once this was cleared up, I would have been more comfortable buying it in this area here. We'll close this video with a standard chart, the S&P 500. It's a daily S&P 500 chart. Let's talk candlesticks here. Indecision in this candlestick here where the cursor is, I'm in this area. Indecision, 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 indecision. You can see resistance here. That's consolidation. Typically what you'll get is a break to the upside or a break to the downside. You can argue now that this 1, 2, 3, 4, here you get a strong stick followed by 4 indecisive sticks. Strong stick followed by 1, 2, 3, 4, 5 indecisive sticks. And obviously the market believes that this is resistance in here. So we're in a situation similar to this where typically you'll get a break to the upside or a break to the downside. Let's look at the probabilities here. Obviously the bulls are in control here. This is 8-day, 10-day, 21-day. We're above all of them. Until we get into this area here, which would be a break here and here, look, the bulls are in control. If you get down in this area here, the case starts to crack a little bit more. Let's examine the probability of where we might go here based upon momentum. This dotted line here shows you the bullish breakout from this consolidation. MACD here, that's a healthy looking MACD. RSI still rising in this area, relatively healthy, no divergence here. This is higher than we are here. Compare that to where we are now. Consolidation, price moving higher where I have the cursor here moving back and forth. Negative or bearish divergence on RSI. Negative or bearish divergence on MACD. When we broke out of this consolidation in a positive manner, bullish MACD cross in place. Now, bearish MACD cross in place. Now, RSI on this move from here to here has been unable to recapture 70. From a probabilistic perspective, if I were taking a test, another bad sign is when you have a market advancing and your MACD histogram is below 0, that's not something you want to have stick around too much longer. So if you're a bull, obviously you want to break this way. And if we do break this way in a bullish manner, you want to recapture 70 RSI. That would be a good sign. And you'd like to see a bullish MACD cross, and you'd like to see this histogram flip from negative to positive. Let's move down on a fair and balanced here. ADX, strength of a trend. This is a very, very, very strong trend that we've been in, and therefore it is possible that we're going to continue to move higher. Weekly S&P 500. Again, fair and balanced. From a negative perspective, this is an indecisive looking candle here. You need follow through off of that indecisive candle. This candlestick here in a weekly chart is meaningless from a rollover perspective until we get some confirmation and move, and better yet, close into this area here. But it is what it is. Reason why I'd like to show this to you, notice Williams percent R on a weekly chart. That's almost max bullish momentum. It did tick down last week, so if you're thinking reversal, that little tick down here is a good sign. Notice when we go back all the way into 2009, you don't really see any period where you've got this almost full throttle momentum to the upside. This is showing a very strong market with a very strong trend, and it tells us that we better keep an open mind about where we go in the next 3 weeks or even 3 months. It's possible that we get another upside move and then 3 months of sideways consolidation, and then we fall. Flexible, open-minded. If the situation changes and the charts improve, we're happy to change with it. If we can find buy candidates that we're comfortable with, we're happy to redeploy our profits and become more bullish again. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.